Look, I'm not one to create panic, but what I'm about to show you is something most financial advisors won't tell you because, frankly, they either don't see it coming or they're hoping you don't notice until it's too late. Right now, as you're watching this, there's a clock ticking on your retirement accounts. And I'm not talking about some vague future threat. I'm talking about a convergence of events happening right now that could fundamentally change the value of every dollar sitting in your IRA, your 401k, your savings accounts. Let me paint you a picture of what's actually happening behind the scenes. The Federal Reserve just made a move that sent shockwaves through the precious metals market. They've signaled a pause in their rate trajectory, but here's what they're not saying out loud. Real interest rates, the ones that actually matter, are at 18-year highs. You'd think that would crush gold and silver, right? That's what every textbook says. Higher real rates mean lower gold prices because the opportunity cost of holding a non-yielding asset goes up. Except that's not what's happening. Gold just rallied near its all-time highs. Silver is showing incredible strength. And this isn't some random market quirk. This is institutions telling you something very important. They're saying the rules have changed. Think about what that means for a second. The traditional relationship between real rates and precious metals has broken down. When the playbook stops working, when the correlations that held for decades suddenly invert, that's not noise. That's a signal. And the signal is screaming that something much bigger is in motion. Let me take you back to a moment in history that rhymes with today. It's 1971. President Nixon is about to go on television and tell the American people that the dollar will no longer be convertible to gold. The Bretton Woods system, the foundation of the post-war monetary order, is about to collapse. But here's the thing. Most people didn't understand what was happening. They heard the announcement, they saw the news coverage, but they didn't grasp the implications. The smart money did. The people who understood monetary history, who knew what happens when a currency loses its anchor, they acted immediately. They moved into hard assets. They protected themselves. And over the next decade, they watched gold go from $35 an ounce to over $800. That's not a typo. A 2,200% gain while everyone else watched their purchasing power evaporate. Now, I'm not saying we're in 1971, but I am saying there are eerie parallels. The dollar's role as the global reserve currency is being questioned in ways it hasn't been since that era. Countries are actively working to reduce their dependence on dollar-denominated trade. The BRICS nations aren't just talking about alternatives anymore. They're building them. China and Russia have been settling trade in their own currencies. Saudi Arabia, the cornerstone of the petrodollar system, is now accepting yuan for oil sales. Think about that. The entire architecture that supported dollar dominance for 50 years is being systematically dismantled, brick by brick. And what are central banks doing in response? They're buying gold at a pace we haven't seen in modern history. The World Gold Council just released data showing central bank purchases remain at near record levels. These aren't small players. These are the institutions that manage national reserves, that understand currency dynamics better than anyone, and they're voting with their actions. Turkey's central bank has been one of the most aggressive buyers. Poland has been steadily accumulating. China's official numbers are probably understating their actual holdings because they have every incentive to accumulate quietly. When you're trying to challenge the existing monetary order, you don't announce your strategy, you execute it. But here's where it gets really interesting for you, for your retirement accounts specifically. The average American has the bulk of their retirement savings in traditional assets. Stocks, bonds, maybe some real estate exposure through REITs. And for decades, that's been the right move. The 60-40 portfolio, stocks and bonds, it worked beautifully. Until it didn't. Look at what happened in 2022. Stocks down, bonds down. The classic diversification strategy failed because both asset classes moved in the same direction. People who thought they were protected, who thought they had balanced portfolios, they watched their retirement accounts get hammered from both sides. Now, what was the one major asset class that held up? What actually gained value while everything else was falling apart? Gold. Silver had its moments too, but gold was the steady hand. It did exactly what it's supposed to do in times of monetary stress. It preserved wealth. And here's the critical point. We're not out of that environment. We're deeper into it. The national debt just crossed $36 trillion. Let that number sink in. 36 trillion. The interest payments alone are now exceeding defense spending. We're paying more to service our debt than we spend on our entire military. And those interest costs are accelerating because rates are higher than they've been in years. So you've got this impossible situation. The government needs to keep borrowing. But higher rates make that borrowing more expensive, which means they need to borrow even more just to pay the interest on existing debt. It's a spiral, and there are only two ways out. Either rates come down dramatically, which would require economic weakness that nobody wants, or the currency gets debased through inflation, which is exactly what happened in the 70s. Actually, there's a third option, default, but that's not really an option for a reserve currency nation. So we're left with the first two, and neither one is good for the purchasing power of your retirement savings. Now, I want to show you something that most people miss when they look at gold and silver. They see the price charts, they see the volatility, and they think it's just another speculative asset. But that's not what's driving institutional accumulation right now. Look at the supply side. Gold mine production has been essentially flat for years. The easy gold has been found. New discoveries are rare, and the cost of extraction keeps rising. Energy costs, labor costs, regulatory costs, they're all going up, which means the marginal cost of producing an ounce of gold is much higher than it was a decade ago. Silver's even more interesting because it's both a monetary metal and an industrial metal, and the industrial demand is exploding. Solar panels use silver. Electric vehicles use significantly more silver than traditional cars. The green energy transition that governments around the world are pushing, that's incredibly silver intensive, and we're not mining enough to keep up with demand. The Silver Institute projects a supply deficit continuing for years. That means more silver is being consumed than is being produced. In any other commodity, that would send prices through the roof immediately. But silver's been suppressed by paper market dynamics, by futures contracts that represent far more metal than actually exists in deliverable form. Which brings me to something crucial you need to understand about how these markets actually work. When you see the gold price quoted, or the silver price, that's being set in the futures market. The COMEX in New York, the LBMA in London. These are paper markets where contracts are traded, but very little physical metal actually changes hands. It's estimated that for every ounce of physical gold, there are hundreds of ounces of paper claims on that gold. Now that works fine as long as everyone's playing the paper game. But what happens when people start asking for physical delivery? What happens when the paper market's credibility breaks down? We got a preview of this during the pandemic. Premiums on physical gold and silver coins exploded. You had this bizarre situation where the paper price was saying one thing, but if you actually wanted to buy a coin, you were paying 20, 30, sometimes 40% over spot. The two markets disconnected, and that disconnect is starting to happen again. Dealers are reporting tight supplies. Premiums are creeping up. The U.S. Mint has had production constraints. These are warning signs that the physical market is tighter than the paper price suggests. Here's why this matters for your IRA specifically. Most retirement accounts are entirely exposed to paper assets. Your stocks are electronic entries. Your bonds are electronic entries. Even if you own a gold ETF, you don't own gold. You own shares in a fund that claims to own gold. And in a real crisis, when everyone's trying to get out at once, those paper claims might not be worth what you think they're worth. There's a reason why sophisticated investors, family offices, ultra-high net worth individuals, they hold physical precious metals. Not paper proxies. Physical metal that they can see, touch, store. Because they understand that in a true monetary crisis, possession matters. Now, I know what some of you are thinking. This sounds extreme. This sounds like doom and gloom. And maybe I'm wrong. Maybe the system holds together. Maybe the dollar maintains its dominance. Maybe inflation stays under control and your traditional portfolio does just fine. But here's the question you have to ask yourself. What's the cost of being wrong? If I'm wrong and you've allocated a portion of your retirement savings to physical precious metals, what's the downside? Gold and silver have held value for thousands of years. They're not going to zero. You might underperform in a raging bull market for stocks, sure. But you've got insurance. You've got protection. But if the people who are sounding the alarm are right, if we are heading into a period of monetary instability, currency debasement, potential dollar crisis, and you're entirely in paper assets, what's your downside? It's catastrophic. It's watching decades of savings evaporate in real terms. This is why the concept of portfolio insurance exists. You don't buy fire insurance because you think your house is definitely going to burn down. You buy it because the cost of being wrong is too high. The same logic applies to precious metals in your retirement portfolio. And here's something most people don't realize. You can actually hold physical gold and silver inside your IRA. It's called a gold IRA or a precious metals IRA. The IRS has specific rules about it. The metal has to meet certain purity standards. It has to be stored in an approved depository. But it's completely legal, and it's been around for decades. Quick aside here, because this is relevant if you're sitting on $100,000 or more in retirement accounts. I put together a free guide that walks through exactly how gold IRAs work. It covers the rollover process, the tax implications, how to choose a custodian, what metals are IRS approved, all of it. It's in the description below. No cost, no obligation, just information so you can make an informed decision about whether this makes sense for your situation. All right, back to what's happening in the markets right now. One of the most telling indicators I'm watching is the gold to silver ratio. This is simply the price of gold divided by the price of silver. Historically, this ratio has averaged somewhere between 50 and 60, meaning it takes 50 to 60 ounces of silver to buy 1 ounce of gold. Right now, we're seeing the ratio compress from elevated levels. When this ratio is high, silver is cheap relative to gold. When it compresses, silver is catching up. And historically, when silver starts outperforming gold, that's been a signal that we're in the early stages of a precious metals bull market. Why? Because silver is more volatile. It's a smaller market. When big money starts flowing into precious metals, gold moves first because it's more liquid. But then silver catches up and often overshoots. In the last major precious metals bull run, from 2008 to 2011, silver went from $9 to nearly $50. That's a 500% move, while gold roughly tripled. I'm not predicting that exact scenario repeats. But I am saying the setup is similar. You've got monetary instability. You've got supply constraints. You've got industrial demand increasing. And you've got a ratio that suggests silver has significant catch-up potential. Now let's talk about what's happening in the derivatives market, because this is where things get really interesting. The big commercial banks, the ones that have traditionally been short gold and silver futures, they've been reducing their short positions. This is data you can see in the commitment of traders reports that the CFTC publishes every week. When the commercials, the smart money, when they're covering shorts, that's typically bullish. They're the ones with the best information. They're the ones who understand the physical market dynamics. At the same time, you're seeing managed money, the hedge funds and commodity trading advisors, they're starting to build long positions. This is the fuel for a sustained rally. You need both sides. You need the commercials stepping aside, and you need the speculators coming in to drive price momentum. And here's the thing about momentum in precious metals. Once it starts, it feeds on itself. Higher prices attract more buyers. More buyers push prices higher. You get this reflexive loop. And because so much of the market is paper, because leverage is so high, the moves can be explosive. We saw this in 2020 when gold went from $1,500 to over $2,000 in a matter of months. We saw it in 2011 when silver went parabolic. These aren't slow, grinding moves. They're sharp, violent rallies that leave people on the sidelines wondering what happened. The question is, are you going to be positioned before the move, or are you going to be chasing it after it's already happened? Let me tell you about a conversation I had recently with a financial advisor. Smart guy, been in the business for 30 years, and he told me something that really stuck with me. He said the biggest regret his clients have isn't the investments that lost money. It's the opportunities they saw coming, but didn't act on. He had clients in 2007 who knew the housing market was overheated. They saw the subprime mess. They understood the risks, but they didn't do anything about it. They didn't reposition. They didn't protect themselves, and they paid the price. He had other clients in 2019 who were worried about pandemic risks, about supply chain vulnerabilities, about the fragility of the system. But they didn't act, and when 2020 hit, they were caught flat-footed. The pattern he's seen over and over is that people intellectually understand the risks, but they don't translate that understanding into action. They wait. They want more confirmation. They want to see what happens. And by the time it's obvious to everyone, it's too late to protect yourself at reasonable prices. Right now, we're in that window. The signs are there. The data is clear. Central banks are buying. Supply is tight. Monetary policy is trapped. Geopolitical tensions are rising. The dollar's dominance is being challenged. All the ingredients are in place, but gold and silver haven't gone parabolic yet. Premiums on physical metal are elevated but not crazy. You can still act. You can still position yourself. The window is open. But here's what I want you to understand about timing. This weekend, markets are closed. You've got time to think, to research, to make decisions without the pressure of watching prices tick. But come Monday, things could look very different. We're heading into a period where any number of catalysts could trigger a rush into precious metals, a geopolitical event, a banking crisis, an inflation surprise, a dollar sell-off. Any of these could be the spark. And once that spark hits, the opportunity to position yourself calmly and strategically, that disappears. I've watched this happen before. In 2008, there was a brief window after Lehman collapsed where you could still buy gold at reasonable prices. But within weeks, premiums exploded. Dealers were sold out. Wait times stretched to months. People who waited, who thought they had time, they missed the opportunity to protect themselves at the moment they needed it most. The same thing happened in 2020. When the pandemic hit and markets crashed, there was a rush into physical precious metals. Dealers couldn't keep up with demand. The U.S. Mint suspended production of certain coins. If you didn't already have your position, you were scrambling to get in at much higher prices. This is why I'm emphasizing the urgency. Not because I'm trying to create false panic, but because I've seen how quickly these windows close. I've seen how fast the market can move when everyone realizes the same thing at the same time. And here's the reality. Most people won't act. They'll watch this video, they'll nod along, they'll think, yeah, that makes sense. And then they'll go back to their lives. They'll assume they have time. They'll wait for more confirmation, and they'll miss the opportunity. But you're different. You're watching this video, which means you're paying attention. You're thinking about these issues. You're concerned about your financial future. The question is, are you going to translate that concern into action? Let me give you a framework for thinking about this. Conservative investors, the ones who are primarily focused on wealth preservation, they typically allocate somewhere between 5 and 10% of their portfolio to precious metals. That's enough to provide meaningful protection without overexposing yourself. More aggressive investors, people who believe we're heading into a major monetary reset, they might go 20, 30, even 40%. That's a much bigger bet. It means you're really positioning for a crisis scenario. Where you fall on that spectrum depends on your situation, your risk tolerance, your time horizon. But here's what I'd say. If you have zero exposure to physical precious metals right now, if your entire retirement is in traditional paper assets, you're taking a massive, unhedged bet on the current system continuing to function smoothly. Is that really the bet you want to make? Given everything we've talked about, given the debt levels, the monetary instability, the geopolitical tensions, the supply constraints, is that the risk profile that makes sense for your retirement security? I don't think so. And clearly, a lot of sophisticated investors don't think so either, which is why they're accumulating physical metal. Now let's talk about the mechanics of actually doing this, because I know some of you are thinking, okay, this makes sense, but how do I actually implement it? If you're talking about retirement accounts, you've got a few options. You can do a direct rollover from an existing IRA or 401k into a gold IRA. This is a non-taxable event as long as it's done correctly. The funds move directly from one custodian to another. You never touch the money, so there's no tax consequence. Or if you're still working and you've got a 401k with your current employer, you might be able to do an in-service rollover. Not all plans allow this, but many do. It lets you move a portion of your 401k into an IRA while you're still employed, and then you can convert that IRA to a gold IRA. The key is working with a custodian who specializes in precious metals IRAs. They understand the IRS rules. They know which products are approved. They handle the storage requirements. This isn't something you want to DIY because if you mess up the rules, you could trigger taxes and penalties. And speaking of storage, this is important. The IRS requires that precious metals held in an IRA be stored in an approved depository. You can't keep them in your house. You can't put them in a safe deposit box. They have to be in a facility that meets specific security and insurance requirements. Now, some people don't like that. They want personal possession. And I get it. If that's your priority, you might be better off buying physical metal outside of your IRA with after-tax dollars. You give up the tax advantages, but you get direct control. There's no one right answer. It depends on your situation. But the point is, you have options. You can structure this in a way that makes sense for your specific circumstances. What you can't do is nothing. What you can't do is ignore the warning signs and hope everything works out. Because hope is not a strategy. Hope is what people who didn't prepare tell themselves after it's too late. Look, I get it. This is uncomfortable. Nobody wants to think about their retirement savings being at risk. Nobody wants to believe that the system they've trusted for decades might be fundamentally broken. It's much easier to assume everything will be fine, that the experts have it under control, that your financial advisor's traditional portfolio allocation will protect you. But the evidence suggests otherwise. The evidence suggests we're in a period of profound monetary transition, and in those periods, the rules change. The correlations break down. The strategies that worked before stop working. This is not the time for complacency. This is the time for clear-eyed assessment of the risks and thoughtful action to protect what you've spent a lifetime building. So here's what I want you to do. This weekend, before markets open again, take some time to really think about your retirement portfolio. Look at your allocation. Ask yourself honestly, if we do see a monetary crisis, if we do see significant dollar debasement, if we do see inflation accelerate, how protected am I? If the answer makes you uncomfortable, if you realize you're more exposed than you thought, then take action. Download that free guide I mentioned. Talk to a precious metals IRA specialist. Get educated on your options and make a decision, because the window is open right now, but it won't stay open forever. And when it closes, when everyone else figures out what's happening, you don't want to be the person scrambling to protect yourself at much higher prices. You want to be the person who saw it coming, who acted decisively, who positioned themselves before the crowd. That's how wealth is preserved in times of transition, not by following the herd, but by thinking independently and acting on your convictions. The choice is yours. You can watch from the sidelines and hope for the best, or you can take control of your financial future and protect what matters most: your retirement, your security, your peace of mind. The clock is ticking. The weekend is here. What are you going to do?